Hello, I'm Finola Burke from RaaS Research Group, and today we're catching up with Dimitri Courtelis, the Group Chief Financial Officer for Ricegrowers, which trades as SunRice, ASX ticker SGLLV. Welcome back, Dimitri, and thanks for joining me.
Thanks for having me, Finola. Good to chat to you again.
Now, SunRice has reported a solid FY26 result, delivering a 4% increase in NPAT to 73.3 million, which was pretty much in line with our forecast, and despite a small 2.7% decline in revenue. What have been the key drivers in delivering that better bottom line performance?
Yeah, a few things in that makeup of the result. So firstly, we have not tried to chase volume or revenue. It's really been around the quality and mix of our products, and particularly the focus on the branded sales, both locally and internationally across our global branded group, and not looking to participate in as many tenders or looking after markets like the Pacific that historically are higher in revenue, but much lower on the margin side of the equation. So that's where you're seeing the softness in revenue, but then that strength in the margin come through. NPAT's obviously strengthening up as a result of profit that we deliver internationally at a slightly lower tax rate than in Australia. We have the OECD principles coming in at 15% minimum tax rate. And when you look at a lot of the jurisdictions that we operate in, we do benefit from a lower effective tax rate there. And as a result, that's improved our overall effective tax rate. We finished the year at around 22% on the ETR line. So that's improved our NPAT to 73.3 million for the year, up on the prior period, as you called out. And again, on the top line, not looking to chase that revenue or that volume that is low margin in nature. So it's really around the quality of the mix that we're looking to deliver. And when you think of the strategy going into 2030, it's really around that aspirational double-digit margin at the bottom line. That's our key focus. And then, of course, growth on top of that, where we hope to deliver more revenue. But it's really that margin first and revenue second.
And across most divisions in FY26, there appears to have been as many tailwinds as headwinds. Moving into FY27, low Australian harvest aside, what are the current key headwinds that could turn into tailwinds and vice versa?
Well, putting the Aussie harvest aside, because that absolutely will be the most material impact, and we called that out in our outlook, which we can touch on in a little bit. But in terms of the rest of the portfolio, the fundamentals around Saver Life and in our pet category continues to do very well. We have our Toscano brand in the bakery segment, which again continues to do well. And in the core rice segment as well, in ANZ in particular, continues to do well. And with the launch of protein rice, which is looking to hit the shelves across all retailers and independents over the next month or so, we're quite pleased with that activation and how we feel that that product is going to hit the market. That's just one example of some of our innovation that we're looking to unfold in FY27. So that's certainly one of the tailwinds, in addition to our existing categories. And when you consider headwinds, we're living in a pretty interesting macroeconomic environment at the moment. We've got inflationary pressures, consumers trading down to private labels. So those types of challenges continue to obviously be elements that we consider going head to head with on a daily basis. So nothing different from what we have been managing in the past, but probably more exacerbated, particularly with the challenges in Iran and the Middle East at the moment. And you basically waking up every day waiting to see what's been tweeted overnight to determine what's happening with global supply chains and the knock-on effect into shipping. And a couple of other headwinds from that particular perspective. There's a lot of product on water going into the markets like the Middle East in particular, and the length of time that generally takes and the reroute of shipping and transportation across the likes of Saudi to get to some of the other Gulf states on the east is a challenge, and that's something that we're managing. But again, it's a market that we've navigated in for a very long time. So we're confident that we'll be able to deliver those products to the consumer and at a price that makes sense for the business. So those are probably the flavors of the headwinds that we're talking about. And obviously, we're quite pleased and looking forward to the tailwinds in terms of how our business is evolving and the underlying growth. So despite the under recoveries that we're expecting from the Australian crop because of the very low harvest, there's a lot of underlying growth in the rest of the business that we would be looking forward to talking to the market about over the coming 6 to 12 months.
And you are flagging a material decline in impact in FY20 over FY27, particularly in the first half, due to that low calendar year 26 Australian rice crop. Can you explain how and in which divisions the low crop impacts earnings?
Yes. So with the outlook that we put out, exactly as you've said, we're expecting a material impact in 27, and we haven't obviously got to the segments yet at the half year, but the way the business is thinking about presenting this is probably calling that impact out separately, because if we put that across the divisions, it's really going to muddy the waters in terms of what's underlying growth on the one hand, and then what is that under recovery on the other. And if that's all essentially muddled together, it's going to make it pretty difficult to understand the fundamentals of the business. So again, as I said, we haven't got there yet, but we're considering ring fencing that amount on the side so that we can continue to hopefully see that growth come through in the underlying businesses. And at the segment notes at the half year is where we'll obviously turn our minds to that discussion. And to the second part of your question, in terms of the H1, H2, because of the transitional costs, moving from a pool to the fixed price contracts, and then of course going from very high levels of shift structures in FY26, looking at those types of elements in the footprints across the Australia network, all of that complexity will be unpicked or unpacked rather in the first half, and we'll take a view on what that looks like, which is why we've called out that the profit for FY27 is likely to be heavily skewed to the second half of the year. So we thought we'd get in front of that and just probably talk about the shape a little bit.
Dimitri, there has been significant front-loaded investment in both talent and marketing over the last 12 to 24 months. What does that return from this investment look like, and over what time frame?
Yes, we've wrapped up advertising and promotions in particular, and marketing as well, and that cost increase has gone up by about 5.1, 5.2 million year on year. And that's really when you look at the fundamentals of the campaigns and the activations that we've invested behind across core rice, across the SavourLife segments, and also the Toscano category as well. So we've invested a lot behind those brands, and we'll be looking to see FY27 to really start to transition those costs into more of a year of execution. So yes, that ramp up is looking at internal business cases and hurdle rates that we hope to achieve. And we're looking at what we've gone from about 2% of NSV up to about 2.3% of NSV from an investment perspective in those areas. And so what success would look like is improved ranging, obviously more turns on the shelf, getting into more pantries at home of consumers, and seeing how those products obviously go through the mix. So we're quite confident with the activation and the innovation that we've launched. We've invested behind the brands, so we feel that we've got the right setup in terms of what it is we're trying to deliver. Now it's going to be around execution and obviously mark that scorecard in terms of how we do. So that'll certainly be a discussion in the next 6 to 12 months as we reflect on that performance in the market.
Just as an addition on that, Dimitri, what's the sort of investment you're looking at for the launch of the new protein product into the Australian market and in the US?
So that's all been embedded in that increase that we previously called out. And again, because that's not just one product that we're looking to launch, it's in addition and in conjunction with the portfolio of products that we bring particularly to the retailers. So it's really around what we can do from a growth on shelf perspective, and then also the depth of the types of products that you are selling into that category, and obviously putting it in the eyes of consumers as well. So it's not a directional increase of just those products in terms of what's ticked up the A&P and the marketing spend. It's really across the portfolio, but it has been very targeted within that portfolio, particularly around that segment that we spoke about in both core rice, the SavourLife products in the pet specialties, and then of course Toscano in the bakery segment as well.
Your balance sheet is probably in its best shape that it's ever been, with debt only related to working capital needs. Obviously, you've always targeted having always looked at M&A opportunities. Are there any that are presenting to the market imminently? And is capital management on the agenda for the company? I mean, is there, with such a good balance sheet, could you look at a share buyback or special dividends?
Capital management always top of mind, and M&A continues and remains to be a core pillar within our strategy. Timing is obviously everything with these things, and you get close on a few deals, but sometimes they don't always convert. But it's also the shape of the deals. When you consider the pipeline over the last 7 or 8 years, we've spent around 152 million to 155 million in M&A activities. But some of those bolt-ons have been quite small in nature, whether it's high single digit or in the tens or in the 20s of millions. As we've grown and scaled up as a business, those types of acquisitions don't immediately make sense when you consider the complexity and what type of synergies you can extract. So it's not to suggest that they're off the table, but it's fair to say that they're slightly fewer and far between. It's more the medium and larger size types of deals that we think are more appropriate for the business that we're becoming. And obviously, when you just think about that from the perspective of, well, what's available, it does limit the size of the list of opportunities rather. So the list remains fulsome, and we continue to explore what's available both locally and internationally as we look to grow our business across a number of jurisdictions as well. The balance sheet, as you called out, obviously with net debt coming in at 1.1 times, and that's all seasonal debt in nature. And the balance at the moment of net debt around 152 million for the year, and strong cash flows that we've delivered in addition to that balance sheet. So that's certainly helped to service the dividend on one hand. But to your question on buybacks, I mean, we would look to put that through the filter of CAPM and what makes sense in terms of where we want to invest, but also continue to look to grow liquidity in the stock. So there are a number of elements that we would need to take into account, some contradicting the other in terms of what would directly make sense for the business. But it's fair to say that we would look at all of these in the same filter and through the same lens as a company.
And Dimitri, historically, the company's managed to maintain its dividend, at least in dollar terms, even when there have been tougher years from an NPAT perspective. Would it be a fair assumption that the board would look to maintain the dividend in FY27?
So I certainly can't comment on future dividends, and the board turning their mind to that position will be a discussion for them at the half year and at the full year in particular. But what I can say is when you consider the strength of the business, the position of the balance sheet, and position of cash flow in particular, that's certainly given the board the comfort and the analysis obviously required to be comfortable with the 70-cent full year divvy that we just declared yesterday. So that was the 20 cents at the interim stage, plus the final of 50, taking the total up to 70. So one step at a time, but it has been a good trajectory to date and a good track record. So that'll be a discussion for the next 6 to 12 months for sure.
Well, thank you, Dimitri, for taking the time to speak with me today. I'm looking forward to catching up with you over the next 12 months to check on SunRice's progress.
Thank you, Finola.